Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. Today is very special because David brought a guest in, and that is Adam Hooper. Adam is the CEO and founder of RealCrowd based out of Portland, Oregon. Good afternoon, gentlemen. How are you?
Hanging in there. How are you?
doing as well as we can given the circumstance, right?
Exactly.
We're trying to run a podcast out of the home is a new challenge, but here we are.
Yeah. So if we hear kids, dogs, airplanes, cars, all that stuff, that's normal now. That's the new normal. That's great. I know that I'm in between you two. Adam, you're in Oregon, and David, you're in New York, and I'm in Nebraska. So we're really spread out here, but thank God for technology that's doing what it is right now.
Absolutely.
David, you brought Adam onto the show. How did you guys meet?
So funny story is that, we've interviewed Adam and worked with him on content and stuff for a bunch of times, but Adam brought me onto his podcast, the RealCrowd podcast. It was probably over a year ago at this point.
Yeah.
But that was the first time I did a podcast. And then, so when things kind of came around in our company and we were thinking about getting into podcasting, I was comfortable doing it because I had already been a guest on with Adam. So now I thought this would be a good opportunity, especially given what's going on in the market, to return the favor, get him on this show and find out what's going on. So thanks for coming on with us.
Absolutely. It's good to be on the other side of the mic every once in a while.
So what is your, we're saying, like, I'm, doing this from home in Brooklyn now. So it's a whole new thing. Been working from remotely for over 3 weeks now, just getting used to it. What's it like on your end?
Yeah. So I was telling Eric before we got on, we had a very early exposure to this, given the first case in Oregon was an employee at the school that all three of my kids go to.
Oh, wow.
And that was at the end of February. So this very quickly went from a thing that we have to kind of pay attention to and figure out how to prepare for to like right in the middle of it. So that was late February. So I feel like we've got some practice with this social isolation thing. We've been hunkered down for a while now. The beauty is technology, right? It's so great. We can do this remote. It doesn't matter if we're in the office or if I'm in my closet. The ability to leverage all this technology that our industry and just generally has been developed makes this so much more possible today than it would have been even just a short few years ago. So I think for that, we're grateful. But yeah, it's going to be really interesting to see how some of these shifts, you said you've been working remote for 3 weeks now. How much of a long-term shift is that going to have on some of these different uses that are going to impact our industry? I think that's what's super interesting to try to see what pieces of this are going to stick long-term and just be some behavioral changes that have a pretty big impact on our business. So I think we're watching that closely and interested to see how some of this ends up.
So can you just talk for 1 second, just give folks who may not be aware what RealCrowd's space in the CRE industry is and so where you're viewing things from?
Yeah. Generally, crowdfunding is the kind of umbrella term for our space. We run a marketplace for real estate managers that are looking to raise capital from accredited investors through our marketplace, essentially. So we'll work with the real estate managers when they're acquiring an asset or recapitalizing or raising capital for a fund. They come to us, we host their offering on our marketplace, and then a number of accredited investors will come in, do their diligence, review the documents, execute that transaction through the platform, and then have that relationship directly with the individual investor. So we've been around, a little over 7 years now, actually. So early 2013, we started the company, and $6.5 billion of real estate through the platform later, here we are. It's been, again, I think an interesting window into the transaction markets that we sit, right? We're involved typically when a manager will put a deal under contract, or if they're looking to recap, they'll engage us, pretty early in that process, around the same time they're going to be working with their lenders. So it's been an interesting shift over the last 3 to 4 weeks of the tone of those conversations and how people are looking forward and where those transaction markets are going right now. So I think we've got a pretty interesting window into the overall transaction activity in the real estate space.
Yeah. So the first question on that is, how are deals moving forward right now? How much of it is people on both sides of the equation? I guess both people putting assets on the market and people looking to invest in real estate. Are deals moving forward, or are we in kind of like a wait and see moment?
Yeah, as with most in our space, it depends, right? We've had a number of deals that have been impacted, whether that's through a lender repricing terms, right? Higher interest rates. We've seen interest rates, certainly on bridge product spike, higher reserve requirements, which require, different look at the capital stack. We've seen folks walk away from some pretty significant earnest money, right? I think we just saw a couple of days ago, Blackstone walk from a $20 million earnest money for a deal in Oakland.
Yep.
That's not an insignificant amount of capital, even for some of these bigger companies to walk away from. So I guess we've seen some transactions just fail, right? Due to a buyer today doesn't want to pay yesterday, let alone last week's price for these assets. I think that's going to be a while before some of that new underwriting shakes through and the sell side realizes what that new reality is, right? So I think we're in this limbo phase where we will see transactions pause. We'll see some people walk away from transactions that were maybe in progress. Maybe they weren't hard on the earnest money yet, or they have to make that decision. Is it something that they're going to walk away from that earnest money? On the flip side of that, we've seen a few deals that we're looking at acquiring maybe all cash. We've seen some recapitalizations that are going to go forward. So depending on where geographically you are, what part of the capital stack you're looking at, I think we'll see some transactions continue, but I certainly don't imagine it's going to be as robust as we've seen over the last 5-6 months.
And do you have a sense at this point is there a sense in the market for what kind of horizon we're looking at for figuring out what the new normal is going to be? We're looking at like 3 months, 6 months, or again, is it just a little bit too early to kind of make those kind of assessments?
Yeah, I believe it's probably still too early. My gut going into this is probably a 3 to 6 month sort of a pause. The unknowns being, again, we have what's different about this time is we have a huge. So real estate entered this crisis in a pretty good position.
Right.
Leverage was pretty conservative compared to historical, certainly compared to the last cycle, right? 08, 09. Vacancy rates were pretty low compared to historical. Rent growth was pretty high compared to historical. So we entered into it with real estate in a pretty healthy position. So this isn't a real estate driven problem.
Right.
My concern is how quickly does it become a real estate problem, right? If you've got massive vacancies, if you've got retail tenants that can't pay their rents, if you've got, I think I saw somewhere up to 40% of New Yorkers won't be able to pay their rents in April. That very, very quickly becomes a real estate problem, right? And so seeing how some stimulus packages can come together, how potential forbearance with banks comes together, to me, that's still too soon to tell. And I don't think, from a transaction perspective, I don't think any of that pain starts to shake out on the sell side for probably 3 to 4 months at the earliest. And I think until that pain is felt and until there's this repricing, I don't imagine many buyers are going to be super aggressive. So I think there will be opportunities out there. I think there's going to be some, maybe some debt maturity driven issues, but even in those situations, right, what bank is going to say that they want to take the asset back right now? It's probably going to be a 90-day extension. We'll see what the world's like then, and then we can readdress. So there will probably be some kicking of the can down the road a bit until some of that can shake out. But until we get a feel for where the floor is from the epidemiological side of this, with this very acute external force that's driving this whole issue, until we see some stability or certainty and understanding around the spread and the impact of that from a health perspective, until we get to there, I don't know how much certainty we're going to have in our industry or just financial markets in general.
Yeah, no, that makes a lot of sense. I mean, one point that I've heard that I thought made a lot of sense too is another kind of, I don't know if the word benefit is right, or at least a good thing. I can't think of the right. It's not a good thing, but at least it's just the reality is that
some less bad news,
or that one thing that's helping right now is that because we went through what we did 10 years ago, and with the credit crisis and the Fed and the Treasury Department and the government having to figure out a bunch of ways to stabilize the financial system, now we had there was a bunch of existing solutions that we could quickly go to this time around. So like TALF being revived very quickly, and at least at this point, guaranteeing buying asset-backed securities, agency-backed securities, and potentially moving on to private label as well. But like not having to have this period of, oh, what do we, what can we do in the financial system when the Fed okay, well, we did these programs last time, we could do these very quickly, and that's going to help stabilize at least the financial system pretty quickly. So that helps get us through this acute period, and then we'll see what happens once this giant economic pause is over.
Yeah,
but at least I didn't have to invent the wheel again on some of these things.
Yeah, the speed and the size of response with certainly compared to 0809 is mind-boggling, right? The I think it was 0809, it was almost a year until some of these programs were put in place. So I agree completely. The speed that we've been able to respond has been certainly a benefit. The size of the stimulus and initiatives that are coming out has certainly been far surpassed anything we've done historically. The concern is, have we used all of our weapons, right? What's left in the tank if this doesn't kickstart things, if this doesn't get that stabilized effect that it's looking for, or maybe we can, maybe we have to invent some new things. So we'll see. Again, I think that's where a lot of this, it's still so fresh. We're still very much in the early stages of this thing. I think it'll be a little while before we see some of these measures that have been taken, what that actual impact is from an actual operational level, right? Not just talking about how's the market responding to these things, but what is the end of day impact to consumers, end of day impact to businesses? Is it enough to weather this, to get them through, and what can that look like on the other side?
Yeah. I mean, it seems to me too, given that one of the points that you made, which I think is a very important one, is that this is not starting with issues within the real estate sector, or even issues more broadly inside the economy. It's not like there's a bubble that's bursting, or there is too much leverage, or some of these things that have created problems in the past. This was an entirely exogenous event that that came in, disrupted everything. It seems to me that if there is the fiscal there are long-term implications to doing a giant fiscal policy, but it's also a recognition that why should businesses that were otherwise healthy be wiped out because of everyone had to stay home, not because people couldn't, people literally couldn't go to work or literally couldn't go to these things. So it seems on a policy perspective, potentially more justifiable to be, okay, if we just underwrite things for a while, we get everything through this, and then when we come back to, so we don't let too many jobs go away, we don't let too many businesses die, and if that's the framework, then that will then have then the real estate fundamentals also will be okay, because we won't have these massive hits on vacancy. But I don't know if that's going to happen, but that's kind of my best case hope for what we see happen with fiscal policy. I don't know.
Yeah, agreed. And I think that's where we're still a little bit early to see how that shakes out, right? I think that's certainly the hope, is that this can bridge this period. If it is shorter, if it's 2 to 3 months of the shutdown, and we can come out of it with good spirits and good confidence, I think that's the optimal scenario right now. Once it's if it goes longer, if this goes into Q3, Q4, we get another big spike in the fall, I think that'll put that stress back on the system and maybe make it a more prolonged. But that's where, again, I just think we're too early in some of this from that, again, very acute external health driven event, until we get some understanding around how broad that's going to be and what that impact is. I think we'll have a little better idea of what the other side of this will look like.
So what kind of things are you telling, the investors that are going through your platform? What kind of questions and what kind of things are you saying? Is it these sort of what we've been talking about more or less?
Yeah, we've long taken a position that real estate starts with risk, right? And understanding the risk of your investments and understanding the risk profile of what you're looking to invest in and how that meets within your own financial picture. And we've been saying for, I don't know, last probably 18 months, last like 5 or 6 years, that we're cautiously optimistic for this to continue, barring some external global event that nobody can foresee.
Right.
And here we are. So, I think a lot of investors are they're still looking at real estate. Obviously, the volatility in the public markets is always going to cause uncertainty and a pause for a lot of investors out there. However, that's one of the greatest benefits of direct real estate investments is that illiquid nature of it. It is that ability to smooth out this daily pricing. Again, in our space of just private markets, right? We don't do anything in the public markets. That is one of the benefits of having direct real estate in your portfolio, is it can act as that hedge. It can act as that smoothing function through equity market volatility. So from that perspective, I think a lot of our investors are coming at it from a pretty good mindset. The depth and the speed that this public markets did collapse and crash and now have recovered, and depending on which day you're looking at it, that causes some people to pause, right? Uncertainty just generally will cause people to pull back and kind of wait and see approach. That said, I think those that have access to capital in the next quarter, 2 quarters, and can move, will have some pretty interesting wealth creation opportunities, right? I think we haven't been able to say that for almost a decade, that I think there will be some opportunities on the other side of this that will have the makings of some potentially really interesting wealth creation opportunities. There's always deals to be had. It's just which side of the table you're on and how hard you have to look to find those deals. So we're seeing a bit of a pause right now until we get some certainty, and then I think we'll see, again, with the transaction markets pick back up, depending on what that opportunity set looks like. I think there's going to be some pretty interesting buys out there.
Well, I think the term that we used last time, we had a whole newsletter about it for about 2 years, was distressed real estate strategies. So coming in, these funds there should be an opportunity for funds both on the debt and equity side that to help any assets that do end up in REO opportunities or that kind of thing. That seems to be how this industry kind of gets through the down cycles, is
right.
Buying those kind of assets, turning them around, and actually there's quite a, if you're successful with that, that's you get pretty nice returns on those kind of strategies.
Yeah, and that's one thing we're trying to figure out. How does our role as the marketplace shift or need to shift to be able to best help people solve those challenges on the existing ownership side, and then also meet those opportunities from the investor side. And in those times, right, you have to optimize for speed and for certainty. And so we're looking at, what can we do within our marketplace? Is there, a different process that we can run? Is there a different pipeline that we can look to generate? Is it forming our own opportunistic fund so that we can be ready and take advantage of some of these opportunities? Because that's, speed and certainty are paramount when you're in a distressed situation. And so that's, as we look through, how does the nature of our business need to change, or does it need to change to better accommodate those situations when they come up over the next handful of months as this continues to play out?
And in terms of looking at the different property sectors, at this point, it seems, from what we're hearing and what we're seeing pretty intuitively, hospitality retail getting the most hammered right now. Mm-hmm. Multifamily, a little bit of a question mark given the number of tenants' ability to pay rent, at least in the short term. But long term, probably, multifamily seems like it's always a good sector. Mm-hmm. Office, a little harder to tell. And then industrial seems, especially given that it's kind of in some ways taking on even a bigger role in distribution than before, right, is actually kind of, sort of in the best spot right now. Does that kind of align with what you've been seeing? It
does. Yeah. I think hospitality to me that's a pretty, again, acute short term. I think once this comes back and people are comfortable traveling, business will go on. The multifamily, very fundamental supply demand imbalance, I don't think this is going to change. If anything, it might exacerbate that, assuming We're not looking at 30% unemployment and 40% of the population not paying their rent. I don't think this changes the fundamentals of that imbalance in the multifamily space. Industrial, I agree. I think that's going to continue to be a bright spot, especially with the additional load that this is causing. I think Amazon is pretty well primed to weather this and put even more load on that kind of shipping, logistics, kind of infrastructure, real estate. Office is interesting. Again, like we talked about at the beginning, how much does this remote thing stick, right? If what we saw in the 08-09 crisis was a 20-30% reduction in labor force, depending on what the industry was. And companies just figured out how to operate more efficiently with that reduced resource. And that just never really changed, right? That was one of the things that stuck. And so if now we can figure out how to operate efficiently with 20 or 30% usage of office space, right? If we can work remote from home, or if we can change some of the layout of these offices for more kind of hoteling of space, what impact does that have long-term for office space usage? I think that's going to be interesting to see how much this sticks as a long-term behavior change. The one that really got me, and I'm having a hard time figuring out why senior housing got just absolutely annihilated at the beginning of this, certainly in the public markets, right? I mean, they were seeing stocks that were down 40+% in the senior living space. I don't know if that was just a massive overreaction to the population that COVID-19 seems to affect, or if there was something else that drove that. But again, I don't see the overall demand for that space materially changing because of this. I think, again, everybody's going to continue to age. To me, I was interested. I don't know if you have any thoughts on that, but I'm really trying to find out why the senior housing space got just absolutely crushed when this thing first started. I don't know if you have any thoughts on that one, or if you've seen anything or any rationale behind that.
I mean, I think we're trying to sort that through too. We're actually got a couple of pieces in the works looking at that. But I mean, I think one thing is just from the perception standpoint, one of the first big stories in this crisis was the facility in Seattle where, a number of people, so I think a lot of people oh my God, these, horror stories about what's going to happen in these facilities if someone goes in. So I think there might've been just that kind of emotional reaction to it. Mm-hmm. But also from an operational perspective, I imagine some of the costs are a little higher right now. If they're having to do extra precautions or extra, more intense sanitizing and things to keep the residents healthy. So I think that seems to be a more, again, another short-term pressures that some of their costs are going up right now as they, to operate these things safely. So, but it is going to be an interesting question what happens. But again, but we are trying to, we've got, it's something that we're actively trying to report out right now on our side.
Yeah, it's again, I agree. I think it was more of an emotional reaction to this. And I mean, if facilities are cleaning their facilities better and making it less likely for any of these things to happen in the future, is that such a bad thing long term, right? I think what's interesting is, with my kids, it's how fundamental some of these preventative measures are. Just wash your hands, right? That shouldn't be that hard. We should just all wash our hands. That's a very basic thing to help, with these different health issues. So I think, again, those are some of those, long-term societal impacts. How is this going to change those behaviors? Or how long are we going to need to mentally have this 6-foot bubble around us whenever we go out in public, right? It's going to be interesting to see how those play out long-term for sure.
Well, Sam, what I wonder about office spaces is, are we going to go is there going to be more demand for cubicles again?
Yeah, I want my office with a door.
I don't want to do these open offices anymore. Just give me some kind of dividers.
Yeah.
So I don't know. Do you have any other thoughts or points you wanted to kind of highlight here?
I think that's pretty good on the different sectors. Another thing that we're paying attention to and trying to see where some of the opportunities might be, or up and down the capital stack, right? How is this going to affect different parts of the capital stack? Obviously, we've got all the margin calls on the lenders that have leveraged in the news. Is there going to be a need for more bridge debt? What does that look like? Are some of these mortgage funds going to be getting squeezed, and maybe there's some opportunities to go acquire some loans? I think looking across the capital stack is also going to be for more sophisticated investors. I think there's going to be some interesting opportunities there. But as we said before, I don't know how much immediate activity there's going to be from lenders in terms of default with these assets, whether it's just technical default or actual default, maturity default, whatever that might be. I think there's probably going to be a pretty good sense of let's put a 90-day buffer in there. Let's put some forbearance or just an extension just to see what the world looks like in 90 days, right? I think there will be some time that's bought before making any of those rash decisions now, just given the levels of uncertainty with all these different aspects that we've been talking about. So I think it's just going to require investors to look a little bit harder for those opportunities, and they will be there. It's just a matter of, I guess, when and what sector and what part of the capital stack.
Yeah, I think it was Moody's that was pointing out that if you looked at previous cycles or like previous shocks, like the financial crisis or 9/11, the delinquency rate on hotel loans didn't really appreciably show up until 8 to 12 months later, partly because of like these initial forbearance periods or like attempts to for the CMBS loans, stuff to the special servicing. So it took, even with that kind of a shock, it did take a while before we saw the delinquency rates like really rising, and then those kind of opportunities emerge. So I feel like there's some sense of like, like what are delinquency rates going to be like next month, and we may not see anything next month,
right.
Because I think just everybody has like this, banks are not going to. I think everything, for all the reasons you're saying. I mean, I think there's going to be, seems to be a pretty good understanding in the market that like we just kind of need to hold steady for a while before we start having these kind of start taking assets onto balance sheets or figure out who really can't pay and that kind of thing.
Yeah, and that's where I believe it is just too early to tell what that looks like. Again, if there's more stimulus that comes out, depending on if there's any regulatory guidance or restrictions around what a landlord or what a tenant can or cannot do, both in the commercial space, right? Here in Oregon, I think your governor just announced that they're putting a stay on commercial evictions too for the next 3 months.
Yeah, that's in New York too.
Is it New York too? Yeah. So these are all unprecedented impacts, right? I certainly don't have a mental model for how to forecast a global pandemic like this. That's when I've been trying to talk.
If you did.
Yeah, I mean, if you find one, let me know. And yeah, I mean, I think it's going to impact everybody differently, and I think there are just so many unknowns from the regulatory side, from stimulus and response side, from just fundamentals, that it's. I hope we know more in kind of that 3 to 6 month window, and we start to see some better understanding and certainty around a lot of these different things we're talking about today. But again, it's hard to tell how long that window is before we get to that certainty.
Well, how about this? How about in maybe 3 to 6 months we come back and we have another conversation and we see where things are at?
Sounds like a plan to me. I'm up for that.
All right. Well, I think we're good. So I thank you for, thank you, especially given the circumstances, taking the time to talk with me, answer my questions, and come on the podcast.
Yeah, great to be on. Thank you for the opportunity, and maybe we'll switch it around and have you on the other side of the mic for an episode on the RealCrowd podcast before not too long.
Sounds good.
All right, Adam and David, this is great. I just sat back and listened to the two guys that know the most in this room. That's you guys. So I appreciate all the good information. And I want to thank you, David, again for bringing Adam onto the show.
Absolutely.
All right. And I want to thank you, the listening audience, for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at NREI, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.